am Jayce Hafner, the CEO of FarmRaise, and I am joined today in the studio with Zach Ducheneaux, who is the Farm Service Agency Administrator. So delighted to have you here today, Zach. Thanks for coming in.
Really good to be here, Jason. Look forward to the visit.
Well, let's just go ahead and dive in. I hear there are some new farm loan rules in effect that could have massive, sweeping opportunity for farmers all across America. And I'd love to learn more about what these rules are and how they came to pass. What should we know, Zach?
Certainly. Well, the first thing we should know is that the rules have been out in public for consumption since the first part of August. And the effective date for the rules began on September 25th, 2024. The reason there was a lapse in time there was we wanted to get the rule out there where our staff could also start to read it and wrap their mind around it. And it would give us plenty of time to train before the rule actually went into effect. So it's been in effect for just about 2 weeks now, 3 weeks maybe. And we're really excited to see what's to come from that rule because it really signals a transformation in the way we make loans at the Farm Service Agency.
Wow. Wow. Can you say more about what that transformation is?
I certainly can. So I think the best way to explain it is we're trying to adopt a different mindset across all of the agency and within the greater department. But the rule really signals the essence of that. To me, farm loans is the most important work that our staff do because without financing, we don't have any agriculture. So the rule really helps our staff in the countryside understand that they're supported in using their discretion to benefit producers and to get producers in the door instead of at times in the past they'd been guided to use their discretion to send people to other opportunities or to other lending institutions, really regardless of the impact it might have on their operation. So the rule fundamentally changes that paradigm. And what we hope to accomplish with the performance of our portfolio under this rule is to really reframe the conversation around ag finance and prove that when we do what our statute actually says, and that is provide financing to meet the actual needs of producers, our portfolio is going to perform better, our producers are going to prosper, and it's going to help rebuild our rural communities because we're going to leave more production out there circulating for a longer period of time.
My gosh, that is such a empowering vision, and it's really exciting to hear that. I'm curious to know more about, as a loan officer, how would my daily life change in terms of the direction I'm getting, starting with, life before this new rule and life after? What would my paradigm be?
I think the best place to explain that is to talk about our authorizing statute. We call it the Con Act, but it can be found in 7 USC, various parts. But the authorizing language for our loan programs says that producers should be able to prove to the Secretary in writing that they cannot obtain credit elsewhere sufficient to meet their actual needs at reasonable rates and terms. Now, when I read that, if we're evaluating whether or not credit meets someone's actual needs, that implies a comparison between what commercial terms would do for somebody and what our terms would do for somebody. In the past, our staff have been guided to make a determination without that and have people go out and seek credit at a lender without regard to what those terms might do. I'll give a couple of examples of our flexibility versus what our friends in the commercial lending arena are typically inclined to. Say you're going to buy a herd of cows. We can typically go to a 7-year note, and our interest rate is around 5% right now. In a commercial relationship, the lender is going to try to get you shorter than that, a 5-year note, which is going to increase your principal repayment amount, but they're also going to be a few points higher on their interest rate, typically nowadays 8-9% for very well qualified borrowers. So that 3% difference plus the slower recapture of the principal that we can offer allows a producer to retain more of that production income, consider growing their herd from retention of their own heifer calves, consider putting away some money for a working capital reserve, things that really would benefit them and make them more resilient and have them be a more prosperous producer and a better participant in that rural economy. After the rule, our staff know that they're supported in doing that comparison. In fact, we've even put a debt consolidation tool up on the USDA's website. So for the first time in history, a producer can put in their financial information and generate a report that would show how much they would save if they were financed at the Farm Service Agency. So they can really start to make that comparison at the front end of this transaction and go into the office knowing that. Of course, they've got to meet all of the normal eligibility requirements, but the way I like to explain access to our credit is really that there are 4 portals you have to pass through. First is credit elsewhere. You have to prove that credit elsewhere doesn't meet your actual needs. We have established flexibility and a comparison for our staff to use to clear that portal. The next is creditworthiness, and producers will prove that through a listing of their debts, and the FSA will then look at their credit history to determine whether or not it appears that they made payments when it was within their control. And we're just all coming out of a 2-year global pandemic, and many of our producers face ongoing natural disasters based on climate change. So it's not beyond the realm of possibility that some of those credit history issues can be explained. So now we've crossed through the second portal, and now we get at management experience. Producers have to be able to demonstrate that they have the management experience to carry out the plan that they've submitted through a history or training or education. And then the last one is cash flow. Does it have a positive cash flow? And in the past, we have not fully examined the cash flow until we cross through all of those other portals. We're putting cash flow front and center for producers now so that we can compare what their cash flow looks like with our basic terms and then add some of the enhancements of the farm loan rule on that so that we can make sure they're getting the best deal at the front end of the transaction.
Okay. So what I'm hearing is it sounds like there are transformations happening at every potential gate, every checkpoint in the process, and these transformations have synergies between them as well. But as as thinking of myself as a loan officer, if I were moving away from the old paradigm into this new paradigm under the new rule, my whole mindset would be shifting from one of default close the gate to default open door and
Yep.
pulling and bringing in, which is a really empowering mindset. What feedback have you heard from folks on the ground since this came to pass?
So far, we've seen really overwhelming support from our farm loan team. And as
Great.
we're explaining this in the training that we did in Houston a few weeks ago, you could see the faces change and the eyes light up and folks thinking, hey, I can do this now.
Mhm,
I
mhm,
think a lot of our staff really feel unleashed and able to go out there and fully be that producer advocate that's really kind of hardwired in all of us in agriculture.
mhm,
There's also some reluctance because it's different
mhm,
and change sometimes is uncomfortable, but we're doing our best to take the feedback from our teams and make adjustments as we go to ensure that this policy is landing the way we hope it does. It's been very well received in the broader stakeholder community as well. We've got statements of support from the American Farm Bureau Federation, National Farmers Union, National
that's huge.
Sustainable Ag Coalition. So, a very broad ranging support for this new approach.
Mhm. It sounds like there is broad stakeholder support here, and I would love if you're able to give us the background, the story of how these new rules came to pass, Was this a spark in your brain at the beginning of your time at FSA, or is there is there a different trajectory? Can you share more about how these came to be realized, along with any advice for anyone working in government trying to advance core policies with many stakeholders involved?
I think it would be a unfair characterization to say that this was a spark in my brain. I think this is the embodiment of the voice of farm advocates ever since the farm financial crisis of the 80s. And a lot of the ideas that we're advancing in the rule are things that some of our more progressive minded and empowered loan officers have really already been doing in some cases.
Mhm.
We're just
Mhm.
codifying it in a rule so that
Mhm.
all of the loan officers know that they're able to do that, and that producers and stakeholders and cooperators, an important part of this ecosystem, can see very clearly what the flexibilities are that the FSA can and will offer under this new guidance. Things that we've heard in the past from our stakeholders and farm advocates are tales of over securitization by factors of 4 or 5 times, losing the family home when things don't go as planned, and FSA offering terms that just keep you in the poorhouse. So we've sought to take a lot of those off the table. The rule is very broad and covers a lot of ground, focuses mostly on our direct loan portfolio. There are a few key provisions for our guaranteed borrowers and our guaranteed lenders to be aware of. But in the 90 some pages of this rule, there are dozens of changes and enhancements to our body of regulation that really all align around this mindset change, getting to yes, helping people be more, helping people feel more economic liberty in their operations, I think is really a good way to explain it.
Mhm, mhm. What's really inspiring about this to me is how this outcome seems to have been built upon and influenced by decades of advocacy and sweat and hard work from folks who have been in this business for decades and decades and decades. Um, I know that you also have a personal story in farming, Zach. Have you found that your experience, as a producer coming from multi generations of producers in your family, has motivated you or has informed your work here?
Absolutely. I think we're all a function of those that came before us. And during my formative years, I was a preteen, teenager growing up on a cattle ranch on the Cheyenne River Sioux Reservation during the farm financial crisis. We didn't know we were poor. Our parents did a really good job of shielding us from that, but come to find out later on in life that the Production Credit Association now identifies as the Farm Credit System. They decided they weren't going to lend in Indian country because there were a couple of bad actors. And they were able to just decide, well, we're not going to put our assets out there despite the performance of any of these other producers. That caused a domino effect for folks like my old man. And we lost the cow herd in the 80s, lost our means of production on our ranch there. And but for the determination of the old man and the resilience of a lot of other producers like him and the goodwill of folks in our community to keep together and support each other, we could have lost the ranch altogether and dad could have had to go to work in town. There's a story I like to share about the local grocery store owner who my dad went and visited with when he knew that he was losing the cow herd and said, Mr. Butler, I'm not going to be able to feed my family unless you extend me some credit. I give you my word, I'll pay it. I don't know when, I don't know how much it'll be, but I'll pay you with interest. My dad and Mr. Butler were able to come to an agreement based on a sense of community. And because of that, dad was able to at least take feeding his family off the table and off his shoulders and focus on getting financing for him and several of the producers through the BIA's guaranteed loan program. But he shopped at least a dozen banks in that process to try to find somebody to take these producers on and help them realize their opportunity.
Mm-hmm.
In the end, when Dad finally got refinanced to get some cattle back out there on the ranch, he ended up paying Mr. Butler at Butler's Jack and Jill about $10,000 or $11,000 in 1980s grocery dollars and paid him with interest. And had it not been for that local mom and pop grocery store owner being willing to make a bet on someone in their community, might not be here having this conversation right now. But I think the important thing to highlight is what we're doing with this farm loan rule is creating an opportunity for those type of relationships to emerge in a community. Because if a producer has money in their pocket at the end of the year, they can maybe afford to go support the local mom and pop grocery store and not have to go to Walmart where they can squeeze every last bit of value out of their production dollar. And then we've got that opportunity. Fact of the matter is, in our local communities today, the Dollar General store manager doesn't have the authority to do this type of thing because everything is driven by the corporate interest and the profit motivation of them, not that sense of community. So the farm loan rule really hopes to pull on that and draw back to that sense of community that existed back then. And it's certainly informed by the experience of myself that I lived, farm advocates like me that worked through the 80s and the 90s and the 2000s, and also by the input from our staff, from all across the country, as they have helped us build this out and strengthen this body of work.
Zach, thank you so much for sharing that deeply personal story about your family's experiences during the farm financial crisis. It really highlights the profound impact that community support can have on individuals and families working in agriculture. And in, today's world, it seems like those kinds of personal relationships are harder to come by, especially with the rise of large corporations and the decline of small locally owned businesses. And I'm curious about how the new farm loan rule aims to recreate that sense of community and support in our modern context. How do you see these changes helping to rebuild vital connections between producers and their local communities?
There have been really three key components that we've highlighted that drive home the mindset shift that we're trying to help our staff embrace. First is the first lamentation that I shared with you that we heard from producers and farm advocates. FSA takes too much security. You're over securitized. You tie me up so that I can't do anything else. Prior to the rule going into effect, our guidance was we will take up to 150% security to secure our loan. We have misinterpreted that for at least since I've been here, and up to has been interpreted to mean at least 150%. That creates a lot of problems because oftentimes those assets aren't severable. They may be assets the producer needs to plan on dealing away in just the normal course of doing business, say a tractor that you're trading in, or your baler, or your hay feeder, whatever you might be using in your Angus cow herd. We've changed that so that we will not take more than 125%. And we were explicit about the language, not more than 125%, because our analysis shows we've never needed 125% to recover in the event that the taxpayer investment needs to be protected. So by taking that step and basing it on data, we've been able to do this at a lower cost to the program, but we're also improving the ability of producers like you and your dad and other producers out there in the country to have assets that aren't attached to this debt so you can transact some business. Let me make that go. Assets that aren't attached to this debt so you can transact some business with a commercial lender and maybe forge a relationship on a different playing field or a different level than what you would if FSA had a security interest in everything, and the only thing you could do is ask for subordination to get that operating line that you might need. So the securitization is a big deal. Another of the pain points that we've heard in the past, producers oftentimes come to the realization that this just feels like it isn't going to work and I'd like to exit from this. Oftentimes, the family home is tied up in that transaction, and losing the opportunity to farm is stressful enough without worrying about whether you're going to lose grandma's house or not. So we're building the homestead protection into this at the front end by not taking the primary residence if we can avoid it and still get to a 1-to-1 debt to asset ratio. That's going to be a fundamental change, and that's going to give a lot of breathing room for our producers. I had a chance to be in Arkansas last fall when some of the poultry complex shut down. And that was the biggest pain point on that producer's mind. My home is tied up in this deal, and I don't want to lose my home. My family needs to live there. So the securitization of our loans is a big change, and getting up to defined better to say not more than is key to that. The second big aspect of this rule change is it's going to allow our staff to think about a producer and their production income the way we do our salary when we're lucky enough to have salaried employment. When I get my paycheck deposited into my account, retirement has been taken out. Health insurance has been taken out. There's even an opportunity for a savings plan that I can invest in and have it be matched. If I still had kids of college age, I could even find an opportunity to have that taken out before I ever think about the take home pay and what is disposable income and what I'm going to do with it. That's my salary. Our producers don't have that luxury typically when they're in a normal lending arrangement. So what we're going to do is start to think about those things from the producer's perspective so that they can plan for a retirement account. They can plan for health insurance from their production income, because we're going to extend the terms of our loan to allow more of that production income to circulate there. Producer may be able to seed an education fund for their child. And think about the paradigm shift there. As we have children that are growing up on the farm or ranch who know that the parents have been able to save for their education from ag production. When they go off to school, they're not going to be looking to go into IT or business administration. They're going to be looking at an ag career because they see the value of it. That's really, I think, empowering. And then I think about the fact that working capital reserves are also something that producers are going to be able to leverage and create using our extended and flexible terms. Imagine going into the bank, knowing that you've got about half of the money you need to operate for the next year to deposit in that bank if they give you a loan to operate for the next year. To go into the bank as a depositor fundamentally changes that relationship to where you're a stakeholder instead of a price taker. And then that bank will have to compete for your business. But the secondary impact of that is that bank is going to have a deposit that they've got to try to get out into that same community so that it can circulate and they can make some money on the deposit as well. So we're really seeding these rural economies with production income that can grow before it's clawed back into the treasury where we have to get another appropriation to support it. Those are the two biggest changes to the delivery of farm loans and the terms that we offer. Another key part of the rule is taken from what we've learned from our distressed borrower work under the Inflation Reduction Act in Section 006. In that program, it's become clear that many times the producers just need to put that payment aside and get back to producing so they can get into recovery mode when things don't go well and they're in some economic distress. The challenge is when we only have a primary loan servicing pathway or a disaster set aside pathway for that. Primary loan servicing is an entire workup of the loan application, restructuring, reamortization, and that may be more time consuming than either the producer or our staff need. Disaster set aside needs a natural disaster to trigger it. Sometimes it isn't a natural disaster. It can be a trade war or a commodity collapse or a animal disease outbreak, any number of things that trigger that distress. So our staff put together the notion of a distressed borrower set aside program where in a low doc version of loan servicing, you can just move the payment to the back end of the note. And because of the opportunity afforded through the Inflation Reduction Act, we were able to forward pay the cost of that so that we can set it aside at an eighth of a percent instead of at the normal interest rate. So that interest doesn't capitalize out there and serve as kind of a time bomb that takes someone by surprise when they thought they were coming to the end of their lending relationship. Important part about that particular aspect, though, Jayce, is because of funding and appropriation anomalies, we had to pay for the existing portfolio for that provision. So that's available to folks who had a loan closed on or before September 25th, 2024. So folks that were already on the portfolio have opportunity to do the distressed borrower set aside. One of the provisions for the terms that we have to offer going forward that offers some equity to new producers is that you can opt into a deferral of principal payment for the first year automatically. You can opt into, if your plan calls for it, 3 years of principal deferral to get the wheels turning in your business. And if justified, we can do an extended deferral of principal payment so that we can really start to kickstart your operation and maybe help you get into the value added sector or be part of a cooperative with equity in your pocket that you can use to invest. So it's really a tremendous opportunity all the way around.
It's truly encouraging to hear about these new provisions and the positive impact they're poised to have on both existing and new producers. It seems like FSA is making significant strides in supporting the ag community more effectively. As we look ahead, I'm curious, what's next for farm loans and FSA's efforts to assist farmers and ranchers? Are there any upcoming initiatives or policy changes that producers should be aware of?
So my next chapter changes significantly on January 21st. That's the last day that I know that I've got this job. But part of the culture change and the mindset shift that we've tried to stimulate embodied in this rule is further elaborated on in some legislative proposals that we advanced in the 25 president's budget. Typically, among the branches of the federal government, there is a separation, and executive branch isn't offered the opportunity to weigh in or suggest legislative solutions. But in the president's budget, which is a policy statement of the administration, this administration has saw fit to talk openly about credit reform and supported us wholeheartedly in the effort to advance the rule. But in those legislative proposals, many of which have been adopted by either or both houses of Congress in their Farm Bill conversations, we're trying to further solidify this notion of credit reform. Because you mentioned the entrepreneurial spirit of our producers. We really hope to capture that. And this administration has been very deliberate about investing in multiple opportunities. And Secretary Vilsack has articulated very well our efforts to try to bring more dollars to the farm gate. And when you have producers that have income left in their pocket after the end of the year, they can start to identify with those that are taking advantage of those opportunities. When you have to spend every last dollar of production to pay back all of the debt at an artificial rate, you don't really see yourselves as participating in the meat and poultry expansion program. You don't see yourselves in the value added producer grant program. You might not see yourself in the sustainable aviation fuel ecosystem that we're working to create. So I think it's key to that, and it's part of a bigger picture of reform that I personally think is way overdue in agriculture. We hear how producers should innovate and produce more, and your push to get your calves bigger on the same footprint every year and have higher quality every year. And up until now, you've been doing that with the exact same loan products that your dad and grandpa and probably great grandpa had. We think it's time for finance to take a look at this, and our commercial lending friends and other funders look at this like an investment opportunity that it can be, and really go in there for the long term. Some of the deepest trouble I've seen producers get in my career helping them with their finances is the terms of loans do not span all the way across the commodity cycle. So you see the cattle commodity cycle, it's about a 10-year, 7, 9, 10-year cycle. Our loans go 7, 5, 3 years. And if you get in at the top of that, cattle prices go down, your lender starts to weaken in their resolve, and they start to look at you as a greater risk. But it's as much a function of the terms that they offered as it is the industry, because as sure as we're sitting there, the price is going to turn and it's going to go back up again, typically a little higher than it did to start with. So if the terms of finance can span across commodity cycles, we can be with producers through thick and thin. And it really aligns with the advice we would get from our investment advisor if we had money in the market. Don't get out in a crash, double down, get deeper in, it's going to recover. We have to believe that of our producers as well. They're going to recover and they're going to stay out here, and our finance tools have to support that. So we hope to prove to the world that our producers on our portfolio demonstrate that terms that meet their needs, that are flexible, will increase the performance of the portfolio and maybe be an example to the rest of the lending industry instead of relegated to serving those that they don't want to serve. We want to bring them along in this relationship. And I think it's worth pointing out that typically all of the terms that we're offering in this rule, a guaranteed lender can say, hey, I want to do that too. Will you still offer me a guarantee? And we certainly will. We will guarantee that flexibility out there to benefit producers so that lenders can help navigate through the realities that they have to go through. Many of our loan officers out there in the countryside have a board of directors that they're reporting to. They have regulators that they have to report to. And if we can provide them assurance that our guarantee will stand when they offer these flexibilities to producers, we can help them take some of those conversations off the table and be better partners for our producers, because in the end, we need all of the capital in lending that we can create in agriculture. I have never heard a producer say, boy, it would sure be good if there was less credit available at a shorter term at a higher interest rate. I don't think you hear that anywhere.
That is such an insightful point, Zach. The idea that flexible, producer-friendly lending terms can not only support individual farmers, but also inspire change across the entire lending industry is really compelling. And it's encouraging to hear that FSA is proactively working with guaranteed lenders to extend those benefits, ensuring that producers have access to the capital they need under the terms that truly meet their needs. And speaking of supporting producers, I'd love to touch on the role of education in all of this. At FarmRaise, we've been collaborating with FSA to develop the Farm Service Agency Educational Hub. This platform aims to provide comprehensive educational content designed to help producers and cooperators better understand and take full advantage of FSA programs. We offer tutorials, videos, interactive tools that simplify some of the complexities and provide step-by-step guidance for farmers seeking assistance. And our goal is really, by making this information more accessible, we aim to empower producers to fully use the resources available to them, ultimately supporting their growth and their success. And this is, such an important initiative for the entire community, and we're just incredibly grateful for FSA support in this work. Their partnership has been instrumental in bringing the educational hub to life, and we appreciate their commitment to educating and empowering farmers and ranchers all across the country.
Jayce, I'd like to add one thing there, if I might, though. So, as a cooperator, FarmRaise has been integral to advancing this and providing tools to producers, but you're one of a growing ecosystem of cooperators that are going to be part of making this a success. The hub that you've put out there in partnership with the FSA and the USDA provides key tools to producers, and it's based on feedback from that ecosystem of cooperators, from their interactions with their producers, so that we're getting what our producers are needing based on the collaboration with their cooperators. And we're taking a new approach to how we embrace cooperators as well. In the training that we did for this rule, we brought the cooperators in and they went through the same training as our staff. We selected, I think, 20 different cooperator organizations. They brought staff to the entire training, went through just like they were one of our team, because we want to have our staff and our producers see this as a cooperative effort amongst all of us. And the feedback we're going to get from that engagement will help guide further training of the cooperators and can continue to help us to develop tools for the educator hub there as well.
Thank you so much for adding that, Zach. It is really inspiring to hear about the collaborative approach that FSA is taking with cooperators like FarmRaise and others in the ecosystem, bringing everyone together for training and treating cooperators as integral parts of the team really shows a commitment to making these programs successful for producers and the wider team of teams working with producers. I appreciate you sharing your insights and the exciting developments happening at the FSA. Thank you so much for taking the time to join us today. I know our viewers and listeners will find this conversation incredibly valuable.
Good to be here. Thanks a lot, Jayce. Keep up the good work.